Okay, now we're going to move on to the second kind of ratio I talked about, and that's asset management ratios. There are several of these because, well, there are several different kinds of assets that we might want to talk about. First of all, let's talk about inventory. Of course, inventory is an important current asset that must be managed properly. The inventory turnover ratio gives us some idea of how efficiently the company is managing its inventory and hopefully using it to generate sales. We like for this ratio to be high because for any given level of inventory we want to see the highest possible level of sales. And I guess theoretically for any given level of sales we would like to do it on the least possible amount of inventory. Now there are some advocates of you might call it just-in-time processing, where theoretically we'd kind of like to keep our inventory to the bare minimum. I mean, ideally zero. Use some common sense with that. You definitely want to have at least some inventory around so that if a customer comes in and needs to buy something, that you're able to sell it to them. So that includes having, a little bit extra there on hand, so you're you don't run out. You have some reasonable assurance of that. But you don't want to just have excess amounts of inventory, way more than you need, sitting around and not doing anything for a while. Okay, because inventory is costly to manage. You've got to have a place for it. You got to store it. You got to insure it. All sorts of things like that. Okay, all in all, we'd like to see high inventory turnover ratios. So how do we calculate this? Well, it's simple. It's just sales divided by inventories. Sales come from the income statement, of course. It's the top line, as you can see here. All right. So this is where we're getting that number. This is where the 7036 in thousands is coming from. And then we look at inventories, which comes from the asset portion of the balance sheet right here. That's going to be, I guess, 1716. So here we go. 7036 divided by 1716 gives us 4.1 times. All right, now what exactly does that mean intuitively? How should we think of that? Well, just imagine, if you can for a minute, all of a company's inventory. So think about everything it has to sell. And of course that could be sitting in different places. It could be out on the shelves. It could be kind of back in a storage area, but all of the company's inventory. So if you picture that for a company, this number suggests that DeLeon sells all of that stuff 4.1 times per year. All right, now in reality, DeLeon is not going to empty out all of its shelves, then reorder the whole thing, and then empty it out again, and reorder, and repeat this 4 times. In reality, it will be replacing things kind of continuously as it goes, so it doesn't ever truly run out of anything. But still, that gives you a good idea of what this ratio means. It's how many times per year we sell our typical amount of inventory that we hold. And it says here that it's just over 4.1. Okay, so before I go on, I should probably mention that in some textbooks this ratio might be defined just a little bit differently. Instead of sales over inventories, it may say cost of goods sold divided by inventories. And that's a perfectly okay definition as well. And I understand some people might even argue that's a better definition. I see that. But for our purposes, we're going to use sales divided by inventories. Still has about the same meaning. Now, how is DeLeon doing in this area? Is it managing its inventory well? Well, I would say no. DeLeon was not doing well a couple of years ago. 4.8, that's below the industry average of 6.1, and then it got worse the next year, and now it's looking even worse. So there's this steady downward trend in the inventory turnover ratio that you don't really want to see. DeLeon's inventory control is probably not good, or it may have a bunch of old inventory sitting around
that it is not likely to sell anytime soon. But either way, it looks like inventory management is a problem area that needs to be addressed. Okay, now we're going to take a look at the next asset management ratio, and that is Days Sales Outstanding, or DSO. Days Sales Outstanding is also known as the Average Collection Period, or ACP. You should be familiar with both names, and of course you're free to refer to it as whichever one you want to, as long as you're familiar with both terms, Days Sales Outstanding and Average Collection Period. The idea here is that we're talking about the average number of days after you make a sale before you actually get paid for it. So just imagine a business making a sale on credit to a customer. Now when you make the sale on credit, you don't get the cash right away. Instead, you get what's called a receivable, right? You record the fact that the customer owes you the money, and you're going to send them a bill, and hopefully they're going to pay you, and everything's going to be just fine according to plan. Now the question is, how long does it normally take for you to receive the payment that the customer owes you? Okay, well, that's what DSO tells us, or average collection period. All right, in order for us to calculate this, we just have to take the level of accounts receivable that the company has and divide that by the average daily sales. Here we have the amount that the company typically makes in sales per day, and over here, receivables, basically that's the amount of uncollected sales that are still outstanding. So this tells us the number of days worth of sales that are still outstanding and haven't been collected yet. Okay, so daily sales, of course, are not really reported on the income statement. Total annual sales is what's reported there. We can calculate daily sales pretty easily, though. Okay, if total annual sales are 7036, again that's in thousands, and we divide that by 365, then as far as daily sales, 19.28 thousand, and then accounts receivable from the balance sheet, that's going to be 878,000. So we can take that number and divide by the 19.28 that we just got, and of course that's going to give us approximately 45.5 days. So this tells us that it's taking DeLeon on average 46 days to collect its money after it makes the sale. Okay, now is that good or bad? Let's take a look. A couple of years ago, DeLeon was collecting its money in 37 days. That was its DSO. The year after, it took a little bit longer, 38.2. Now, of course, it's looking at 45 or 46 days. That's a lot more, and especially when you consider the industry average is 32 days to collect. This does not look good for DeLeon. Okay, this looks like DeLeon is possibly extending credit to some customers that it shouldn't be extending credit to. All right, it may have a poor credit policy. It may be letting people buy on credit that it really should not do that for. Now there is one possibility. DeLeon may have purposely adopted a more liberal credit policy, perhaps saying that the competition, they demand that you pay in 30 days. Well, here at DeLeon, we'll let you pay in 45 days or something like that. If they're purposely doing that as a tactic to increase their sales, then that's one thing. But if that's not the reason, if this is just happening and they're not purposely allowing it, then they need to look at something, okay? Because having sales drag on longer and longer like this without being collected is not a good thing when it comes to cash management. Okay, now we move on to a couple of other asset management ratios, and here we're looking at fixed asset turnover and total asset turnover. Here we are looking at
how well are we using those assets to generate sales? It's kind of a general indicator. With fixed asset turnovers, we look at our level of sales compared to our level of net fixed assets from the balance sheet. And we do that because, well, the fixed assets that we have are probably, it's impossible to know for sure exactly what they are without more detailed information, but they are probably used in the overall process of generating products and generating sales for the firm. So how are we doing as far as generating sales on whatever level of fixed assets we have? Well, this is an indicator of that. So we take the sales figure, 7036, divide by net fixed assets of 817, that's in thousands, and we get 8.61 times. So our sales figure is 8.61 times the level of net fixed assets. With total asset turnover, it's the same exact idea, except we are not just looking at net fixed assets, we are looking at total assets. So total assets for DeLeon most recently is 3497, and so when you look at the sales of 7036, you can say that DeLeon sells about twice the level of its total assets in this most recent year. And by the way, you will notice that, of course, the number for total asset turnover, 2.01, is less than the number for fixed asset turnover. That's just a mathematical thing that is going to happen. It doesn't necessarily mean that, oh, this is worse than this. Okay? Mathematically, that's always going to be true. Because sales is the same for both ratios, but total assets is going to be larger than just net fixed assets, because total assets includes net fixed assets plus some. It includes current assets also. So you've just got a larger denominator here, causing the ratio that you calculate to be smaller than this other one. Doesn't mean that one is worse than the other necessarily. In order to determine whether the company really is doing well or badly in this area, we need to do, the trend analysis and the industry analysis and see how that's going. Well, what do we see here? For fixed asset turnover, DeLeon was at 10, which is above the industry average of 7. That's good. Then it dropped to 6.4, which is not quite so good, but now it's coming back up to 8.6. It's above average. No problems there, really. There's no indication here that DeLeon is being inefficient with its fixed assets. At least that part seems to be okay. But what about total asset turnover? Here there's a little bit of a cause for concern. It started at 2.3, which is below the industry average of 2.6. Then it dropped a little. Then it dropped a little more in the most recent year. And it's just, it's not anything terrible, but it seems to be drifting in the wrong direction a little bit each year. So this is something that does need to be improved. So why do you think this total asset turnover is not looking good? What kinds of assets specifically do you suppose are the problem? I would suggest to you that it's probably not fixed assets. If you look up here, fixed assets, they seem to be managed efficiently to generate sales. The fixed asset turnover ratio looks fine. So why is that fine and total assets is not fine? Well, what other kinds of assets do you have? Current assets, perhaps? Right? Those are the two main categories that we look at anyway. Fixed assets along with current assets. What kinds of current assets do you suppose? Well, accounts receivable is one, inventory is another, and you know what? That just confirms what we already know. We already saw on the inventory turnover ratio that that's heading in the wrong direction. We already saw under accounts receivable that DeLeon is taking longer and longer to collect when it probably shouldn't be. So given all of those things, it's probably not all that surprising that fixed assets may look okay, but total assets doesn't necessarily look that good. Okay, so all things considered, this gives us further indication that DeLeon needs to look at its accounts receivable and inventory management, and if it did that, it could probably improve things. Alright, next let's talk about the third category of ratios that I mentioned earlier, and that's debt management. We're going to be looking at two things here. First, we'll have the debt ratio, and then we'll have the times interest earned ratio. First, the debt ratio. Okay, the debt ratio, by the way, is also called the debt to asset ratio. Why? Because it's calculated as total debt divided by total assets, hence debt to assets. The idea here is, first of all, I want you to realize that for every dollar of assets a firm has, it must be financed somehow. And there are fundamentally two different ways of financing an asset. One way is by borrowing the money necessary to obtain it. And if you do that, if you borrow it, then that creates a debt. The other way is for the owners to contribute the capital. Could be either from money that the owners infuse into the business out of their own pocketbooks, perhaps by shareholders buying new common stock, or it could be from retained earnings, where the company earns profits that would belong to the owners, but they aren't paid out to the owners as dividends. Instead, they're kept in the business and reinvested. That would be a form of equity. So there is debt financing and there is equity financing. And the debt ratio answers the question, what percentage of the assets are financed by debt? That is, by borrowing. So let's take a look at the balance sheet, which can give us a good view of what's really going on here. Okay, now I think we said this earlier, but this section shows us the debt that the firm has used to finance some of its assets. This part shows us the equity that has been used. So if you will look at these two numbers, I guess, that's current liabilities and long-term debt. Okay, these two numbers, and add them together, you will get, I guess that would be 1545 in thousands. Again, just adding those two numbers together that we just saw on the balance sheet. And then of course we would divide that by, this is one part of the pie, the overall pie. Now of course this number, 3497, represents our total assets, and that's the entire pie. Okay, that's the size of the entire firm. And of course we can see that number down here at the bottom of the balance sheet. It says total liabilities and equity, but as you know, that's the same thing as total assets, which you would have found on the previous page. Okay, so the debt ratio tells us how big this portion is compared to the entire thing. And if we do the math here, we'll see that it's 44.2%. So that tells us that for every dollar of assets that DeLeon owns, approximately 44 cents is borrowed. And of course that means the other 56 cents represents equity, or an ownership interest by the stockholders. Okay, so I think it's worth pointing out on this debt ratio that when it's relatively low, that means that the company does not use a large amount of debt, and in fact it uses a little more equity. On the other hand, if the debt ratio was relatively high, then it would mean that the company uses a lot of debt and not much equity financing. I say that because I'll ask you to do some analysis probably later in the chapter and in the homework, where you might be asked a question of something like, does this company use a lot of equity financing or not. And at first you may be confused by that because you might say equity financing, well there's no equity ratio here. Oh, but remember, debt and equity, basically that's a trade-off. If you have more of one type of financing, you have less of the other, and vice versa. So if I ask you if this company has a lot of equity financing, I'm basically asking you, does it have just a little bit of debt financing? And conversely, if I say, does the company have, very little equity financing, I'd be asking you, does it have a lot of debt financing? Okay, so that's the debt ratio, and also called the debt to asset ratio. It tells us how much debt financing we use. Now the next ratio, times interest earned, is different. It tells us of the debt that we have, how able are we to at least pay the finance charges? All right, to at least pay the interest expense on the debt. And for that, we need to look at the income statement. Okay, here is our income statement, and you'll notice that interest expense is here, and above that we have operating income, which is earnings before interest and taxes. So really we're just comparing these two numbers. If you will look at this, you'll see there's about $70,000 in interest expense and a little over $490,000 in operating income, which can be used to pay the interest expense. So looking at this and doing the division, you can see that for every dollar of interest expense you've got about $7 of operating income, EBIT, to pay that. And you'd certainly want this to be higher rather than lower. You don't want to just barely scrape by. You don't want to have just barely enough to pay the interest expense. You want to have considerably more than that. So how's DeLeon doing in this area? Well, the answer is not too bad, really. If you look at the debt to asset ratio, it was at 54.8%, and then the next year this is not good. The 82.8%, that would be a real problem for most companies. They wouldn't want to be that leveraged. They wouldn't want to have that much debt. Over here, with the changes that it's made for the most recent year, this is not so bad. 44.2% compared to the industry average of 50%. It's actually a little below average, and that's okay. In fact, it could be argued that that's a good thing. Times interest earned, you want that to be high. Okay, the industry average is 6.2. DeLeon wasn't there for the last couple of years, but now it's looking like it is going to be there, and in fact a little above. So actually it is looking good as far as its debt management ratios. No major problems there that we can see.